Welcome to Module 7, Three-Statement Model Integration, delivered on behalf of SNB experts. Today, we will master the art of linking financial statements. This module focuses on linking the income statement, balance sheet, and cash flow statement to create a cohesive financial model. In this session, we will learn how these statements interconnect and build integrated statements from the ground up. We will cover everything from circular references to model integrity checks and troubleshooting techniques. Let's start by looking at the high-level framework of an integrated model. A standard model includes the income statement for profitability and the balance sheet for financial position. The third pillar is the cash flow statement, which tracks the movement of cash through operating, investing, and financing. The primary link between statements is net income, which flows into retained earnings on the balance sheet. Other critical links include depreciation, which affects all three statements, and capital expenditures, which impacts PP&E. Finally, the ending cash on the cash flow statement must always equal the cash balance on the balance sheet. Never forget the golden rule. Assets must always equal liabilities plus equity. If it doesn't balance, there is an error. Every transaction affects both sides equally, whether it's borrowing money or earning a profit. Now, let's focus on building the income statement component of our model. The structure begins with revenue, followed by COGS to reach gross profit, and then operating expenses to calculate EBITDA. From EBITDA, we subtract depreciation to get EBIT, then interest and taxes to arrive at the final net income. We evaluate performance using key metrics like gross margin, EBITDA margin, and net margin. Understanding the typical ranges for these percentages helps in benchmarking and identifying potential modeling errors. Depreciation is unique because it impacts every statement. It reduces net income but is added back for cash flow. On the balance sheet, it increases accumulated depreciation, reducing the net value of your fixed assets. Next, let's examine the complexities of constructing a balance sheet that truly balances. Assets are divided into current items like cash and inventory, and non-current assets such as PP&E and intangibles. The other side comprises current and long-term liabilities, as well as equity items like common stock and retained earnings. Working capital accounts like accounts receivable and inventory are often driven by operational metrics like days sales outstanding. Similarly, accounts payable is driven by days payable outstanding, directly reflecting the company's payment terms. Retained earnings is the master link. Ending retained earnings equals the beginning balance plus net income minus dividends. This simple equation is what mathematically ties the income statement directly into the balance sheet's equity section. Fixed assets require a separate schedule. We track gross PP&E by adding CapEx and subtracting accumulated depreciation. Net PP&E, which appears on the balance sheet, is always the gross PP&E minus the total accumulated depreciation. Moving on, the cash flow statement is the final component that reconciles everything back to the actual cash position. The statement is organized into three distinct sections: operating, investing, and financing activities. Operating tracks day-to-day business, investing captures asset sales and CapEx, while financing tracks debt and equity changes. Using the indirect method, we start with net income and add back non-cash expenses like depreciation and amortization. Then, we adjust for changes in working capital accounts to arrive at the net cash from operating activities. Remember the rule for working capital. An increase in assets is a use of cash, resulting in a negative adjustment. Remember the rule for working capital. An increase in assets is a use of cash, resulting in a negative adjustment. Conversely, an increase in liabilities, such as accounts payable, is a source of cash and is recorded as a positive adjustment. The net change in cash from all three sections is added to the beginning cash to find the ending cash balance. Now that we understand each statement, let's look at the step-by-step process of integrating them. Start with the income statement, then link net income to retained earnings, and build your balance sheet accounts. Check for balance, build the cash flow statement, and verify that ending cash reconciles with the balance sheet. Always build integrity checks into your model to ensure the balance sheet balances and cash reconciles automatically. Also check for common Excel errors like ref or div E0 to maintain professional standards and model reliability. One common challenge is the circular reference between debt balance and interest expense. Interest affects net income, which affects cash. This created loop where cash needed affects the debt balance requires specific handling to avoid Excel errors. Solutions include using beginning debt balances for interest or enabling iterative calculations in your Excel settings. While beginning balances are simpler, iterative calculations provide the most precise model results for sophisticated modeling. Watch out for common errors like unlinked retained earnings or incorrect signs for working capital changes. Inconsistent depreciation between the income statement and balance sheet is another frequent source of unbalance. Always test your model. Run balance checks every period and perform sensitivity analysis by changing key assumptions. A great test is the zero revenue test. If you set revenue to zero, your model should still balance perfectly. Free cash flow is a critical metric calculated as cash from operations minus CapEx. It shows cash available for stakeholders. A positive FCF means the company generates surplus cash, while a negative FCF indicate a need for external financing. Best practices include building in a strict sequence and using separate schedules for PP&E and working capital. Maintain clear formatting with color coding and document your major assumptions to make the model user-friendly. In summary, mastering integration is essential for professional modeling. Always remember, net income is the primary link. A fully integrated model is dynamic and accurate, serving as a powerful tool for financial decision-making. Thank you for following SNB experts for this training. Be sure to hit the subscribe button for more deep dives into financial modeling.